All right. Hello, everyone, and welcome. Thank you so much for joining us today. Without further ado, it's my pleasure to introduce to you Kim Ann Curtin. She's the founder of Wall Street Coach, along with the host of the popular Wall Street Coach podcast. Kim will be joined today by Grant Williams, author and publisher of Things That Make You Go, and the host of the Grant Williams podcast. Now, to our live viewers, please type any questions you may have into the chat box. And if we have time at the end, I will try to announce a couple of your questions. With that said, guys, I'll be right here if you need anything, but I'll go ahead and mute myself now. The floor's all yours.
Thank you so much, Charlotte. So great to be here, everybody. Thank you so much for coming to this conversation with the legend, Grant Williams. I got to meet Grant about a year ago through our mutual friend, Jawad Mian, and I'm going to read you his formal bio first. Grant is the author and publisher of Things That Make You Go, and host of the Grant Williams podcast. He's also one of the co-founders of Real Vision Group. He's spent over 35 years in finance in a variety of global financial centers, building the kind of network really only others can dream about. Certainly I dream about that. Currently, he is a senior advisor to Matterhorn Asset Management AG in Switzerland and a portfolio and strategy advisor to Volpa's Investment Management in Singapore. His Real Vision interview series, In Conversations With and On the Road, raise the bar for financial content, engaging and educating viewers in equal measure and helping them learn the secrets behind a group of extraordinary investors' success. His new series of video conversations about time continues that legacy. Thank you, Grant, for coming to this conversation today. It sounds like you're muted to me anyway.
Oh, I'm sorry. I was going to say, my apologies, Kim. It's good to see you. I was going to say, if I knew you were going to read all that, I would have just told you to wind it all up and get on with it. I don't think anyone needs to know 90% of that, but.
Well, I think it's important because especially your ability to see the big picture globally is rare. I don't think the majority of people have your 35-year experience, but also you've been in the centers of the world in ways and seen things that I don't think everybody's seen. So that to me is part of why your vision is so clear all the time. So just maybe talk a little bit about that. What about that experience allows you to see perhaps that which escapes other investors?
You know, I don't know that it's necessarily any one thing. I think I've been very fortunate to have lived and worked in a bunch of financial centers around the world in different periods of time since the mid 80s. And so, you know, I've seen different cultures, I've seen different attitudes to investing, and I've seen different markets, and I've seen them from different places. And I think, you know, everybody has the ability to just keep their eyes open and pay attention to what's happening around you. It's very easy in the moment to get caught up in what's happening right in front of you right now. But I think being aware of what's going on and mentally taking the time to sit and process information. You know, we're bombarded with headlines and stories and God knows what every day of our lives now. And so it gets really, really difficult to try and distill that into something you can do something with. And oftentimes the stuff that you hear and the stuff that you read is not necessarily something you can do something with, but you just kind of have to recognize that and put it to one side, but remember it, you know, because there's a point in time when it might become useful. So I think for me, I definitely don't have any great gift. I just think I pay attention. I've learned to pay attention over the years by not paying attention. You know, that's really the best way to learn, that you have to do it when things kind of sneak up on you and tip everything over, and you realize when you do the post-mortem afterwards, you know what, if I'd have paid attention to this and this 2 weeks, 3 weeks, a month, a year beforehand, I would have been better prepared. So, you know, that's really what I think the best advice I can give people in that sense is just really pay attention to what's going on around you. Even if it feels irrelevant, that's fine, but just kind of try and keep it parked away somewhere. And if you read articles that resonate with you, even if you don't know why, you just find them interesting, just make a note of them, bookmark them in your browser or something, keep them to hand, because I think everybody has this gut instinct that tells them, if they get out of the way and allow it to, you know, this might be important at some point.
Yeah, yeah. 2022 was just a hell of a year in finance. And I'm just curious what lessons investors need to really take from that? Because even in the pain, there's so much wisdom. So what would you say are those things into this new year they can take with them from that?
Yeah, I think the point you make about pain is an important one, because that's really how we learn most of our important lessons, is through getting things wrong, and that the pain associated with them is what stops us doing it again. So I think there's been all kinds of pain in 2022, and even though let's say it's extremely unlikely we'll get another year like 2022 and 23, I suspect it will be every bit as volatile, every bit as emotionally fraught as last year, but for different reasons. And so, I think managing your emotions is perhaps the most important thing, because we're all tested every day in what happens to our portfolios. And whether you start by having the wrong position on or having the right position on in the wrong size, there are all kinds of things that tug at your emotions and urge you into doing things in a kind of rash manner, without really sitting back and thinking about them. So I think that pain is important. I think we learned last year that when big shifts happen, really seismic shifts, like the shift from deflation to inflation was the big one last year. They kind of happen out of nowhere. We've had 40 or almost 50 years of declining, let's call it disinflation for the time being, with periods of deflation in there. And so you've got an entire generation of people that have only known that market environment. And suddenly, seemingly out of nowhere, even though people have been warning about it for some considerable time, that inflation was going to be the real danger, the longer it doesn't show up, the less of a threat people deem it to be. And of course, when it gets here, that's when you realize just how important a threat that is. So understanding that these big shifts can happen very quickly, I think is a key lesson to learn. I'd also say that with that change from a disinflationary / deflationary environment / mindset amongst investors to an inflationary one, everything changes. With the return of positive interest rates, everything changes. You can be paid 4.5% to sit in 2-year treasuries and just wait. And that completely changes attitudes towards all kinds of risk. And I think we're seeing that. We're seeing that in some of the asset prices right across the spectrum now, reflecting the idea that people can take no risk at all and get paid 4.5%. And even though it's not keeping up with inflation, that doesn't necessarily matter to people in the short term. If you can get paid 4.5% to take no risk at a time of great volatility, it's a smart thing for many, many people to do. So I think that's an important realization for people to have, that these things fundamentally change the way the experienced investor's mindset works. Now, the last one I'd say is probably looking at media narratives and understanding that they can shift very quickly too. Two superb examples of that really in Sam Bankman-Fried and Elon Musk. Sam Bankman-Fried was the white knight, the JP Morgan of crypto, and almost virtually overnight became the biggest pariah since Bernie Madoff. And Elon Musk was the darling of the left, and with his purchase of Twitter and his subsequent involvement in that company, has become the darling of the right and the demon of the left. And so, these things happen at times like this when there's great volatility. Everything kind of shifts around, and so it's really difficult for investors to find a way to be steady on their own feet and let all this stuff happen around them, but not let it pull them every time it comes up. You have to try and keep balanced and have to try and have a process and a discipline and a framework that helps you take the stuff in, as I said before, but not necessarily react to all of it, but just acknowledge it, work out which pieces of it will affect you directly and your positioning, and then do something about it.
What would you say are the top 3 things investors do need to pay attention to in 2023 as we come into it?
Top 3 things. I think the first and foremost one for me personally, anyway, is the Bank of Japan. I think the Bank of Japan finds itself now in a terribly, terribly difficult position. It's one of its own making, but that's neither here nor there. You can long for the world as you wish it to be, or you can deal with the world as it is. And we as investors have to deal with the world as it is every day. And now the Bank of Japan is being forced to do the same thing. And I think we have Kuroda-san, the governor, stepping down in April. And my friend James Aitken in London was talking about this recently. When the last governor left in 2013, Shirakawa-san, he was kind of thrown under the bus right before he left to make sure that the guy coming in had a clean slate and his own policies. And of course, Kuroda-san is synonymous with yield curve control and pegging the 10-year JGB first at 25 basis points and latterly at 50. And when they made that change several weeks ago to 50 basis points instead of 25 for the ceiling, that told the world that they were at a point where they were having to consider changing things. And you've got the whole world has been watching the Bank of Japan for decades now. Some of them saying, well, if the Bank of Japan's managed to do quantitative easing without any material adverse effects, then everyone else is going to be fine. And I think anyone that's watched them closely understands that the Bank of Japan is in a very different situation to the Fed, the Bank of England, ECB, for example. And so now that the Bank of Japan have clearly been forced by the markets to shift their policies, it sends a message of vulnerability around central banks. So I think for me, number one, with the Bank of Japan being as important as it is, the Japanese economy being as important as it is, and the sheer amount of money tied up in the Japanese yen carry trade, I think you have to pay attention to that, because if the flows into Japanese yen accelerate, that money's coming from other places, a lot of it in the United States. So we could see a massive reversal in money flows, which will change an awful lot of things for an awful lot of people. I mean, other things I would keep an eye on. You can't take your eyes off inflation yet, even if it starts to come back down again. And there's a very clear path for it to come back down to 3% by the end of the first half of this year. If that's accompanied by this much awaited, much hyped Fed pivot, you need to pay attention that acceleration doesn't re-accelerate again, because I think the next time it does, if it comes back again, it'll be much stickier, much harder to beat. So I'm paying attention to that. And also regulatory agencies. I just watched the Netflix documentary about Bernie Madoff on a flight home in the last couple of days, and it's a fantastic documentary. Yeah. But you as you watch it, at the end, you realize that poor Harry Markopoulos, who just did a phenomenal job in pointing this thing out 8 years before anything was done about it, and at various intervals in between 2000 and 2008, and was completely ignored by the regulatory agencies. You realize, given what's happened recently in the last couple of months, that having seen how badly they performed, the SEC I'm talking about now in the Madoff affair, and how hard they were dragged over the coals by the congressional committee that they had to sit in front of, you would have expected something to change. And as we look at particularly Sam Bankman-Fried and some of the stuff that's been going on in the crypto universe, it seems that nothing's happened. So I'm watching the Bankman-Fried FTX thing very closely to see how the regulators come down on this, because there is a chance that they will have to come down very, very hard on this to reestablish any kind of credibility. So I think that's going to be important for investors as well. And then I guess the other thing that I would pay attention to, you asked me for 3, I'll give you 4, but that last one's a quick one. And that is the ongoing shift away from the dollar as I won't say the global reserve currency. I think it's safe from that standpoint, but a move away from it having such a significant portion of those global reserves as oil producers try to free themselves from the kind of slavery that being forced to use the dollar puts on them, and try and deal with buyers of their oil in their own currencies, notably the yuan, the ruble, Turkish lira, and I suspect in time we'll see the Japanese yen. So those are the 4 things that I'm watching from a macro perspective to see how they might affect things.
We're seeing such big swings with Tesla, Just what lessons do you think investors need to take from these kinds of actions? Just there seems like there are, like you said, just continuous shifts. The shifts are coming into 2023. What are they to learn as they watch that unfold? Maybe they were in Tesla, maybe they weren't, but what do they need to know about that?
So I think there's a bunch of lessons to be learned from something like Tesla, whether you were in it or not. So let's kind of walk through. In fact, there was an article in the Wall Street Journal just this week, and the title was "What if Tesla is just a car company?" Um, and I think that's a really important article because at the end of the day, that is the crux of the whole Tesla debate, right? The bears, and I count myself among them. I'm unashamed of that. Um, insisted it was a car company and should be valued as such. And the bulls insisted it was much more than the company. It was a software company. It was all these things that were promised, but it was a robo taxi company. It was artificial intelligence company. And 2 years ago, it was priced accordingly. It was priced as though it was an AI company and a robo taxi company and a software company. And now, as I pointed out, with the return of a cost of capital, it's being priced like a car company again. And the transition from one to the other, when, as I say, you don't have to follow someone's dreams to make returns. You can make 4.5% for doing nothing. That was always going to happen at some point. It was always going to happen. And it was always going to be an incredibly painful thing to watch happen for the people who bought into all the hype. And there is an appropriate valuation for Tesla somewhere, and that's what the world is trying to figure out. We're still fighting between the bulls and the bears. The dream hasn't died yet, and so there are still people that are seeing this as a great opportunity to buy. And the fact that they're reducing prices on their cars now is hugely bullish because they're clearing the decks for you can make up anything you want, really. And like it or not, Tesla was a quasi religion. We've seen these stocks before, stocks that people genuinely believed in. They had faith in them. They had faith in the company. They had faith in Elon Musk. And again, it goes back to my point earlier on. That faith in Elon Musk has been shaken by what he's done at Twitter, which the only effect that has on Tesla, it takes time away from him being hands-on in Tesla. So you can argue that both ways. So I think these big swings are very different depending on what you're seeing. For me, it's perfectly understandable. It's just a re-rating of an overpriced car company to reflect its real valuation. If you believed in hype and you had a lot of your net worth in Tesla, which a lot of people did, you're scratching your head, you're feeling a lot of pain, and you're struggling to understand why the world doesn't see what you see anymore. And again, I would say to people, look, this 4.5% 2-year treasury makes a big difference to just about everything. And the number of conversations I've had with investors over the last few months, and this idea has come up that I can get paid to wait now finally, is a material change. So I think Tesla is a microcosm of this return to financial principles after a couple of decades of kind of fantasy valuations, because money was free, and when money's free, there's no cost to it. So people are much more trivial with where they put it and how they invest it. And the startups that attracted tens, if not hundreds of millions of dollars, wouldn't be able to do that today when there's a cost of capital. So I think Tesla's a very important stock. I think people should watch it and use it as a barometer, as a microcosm of the broader financial landscape.
So what I'm hearing you say repeatedly is that you have to be cautious as an investor, that you don't get caught up in hype or the excitement, and to be sure you have your own due diligence and your own strategy that perhaps transcends what's popular.
Yeah, look, I think you always have to be cautious as an investor. And that's probably one of the things that we've gotten away from in the last number of years, is that this idea that being cautious would cause you to miss out on making money at the best, and the thought of losing money didn't exist. It was always buy the dip and markets will bounce back. So the idea of caution, caution's been frowned upon. If you weren't taking risk, what the hell's wrong with you? You should get out there and take risks. But the simple truth is, whether you've been an investor in these last 10 years or in the 70s or in the 80s or during the dot-com bust, it doesn't matter. You've always got to have an appreciation of the risks. And I think that's probably the most dangerous thing that's happened to the average investor in the last 20 years is this constant reinforcement that you should take more risk. And it comes, from central bank policies. They've encouraged people to take risks. They've voiced that in so many words. They've said that people should take more risk. And we've seen in Australia already the central bank governor apologizing for the people who took on the risk that he suggested they do by ensuring that rates were going to stay at zero until 2024. So yeah, I think it's really important to understand that there is a risk in everything we do. There's a risk getting out of bed in the morning, especially if you've got kids with Lego, and there's a risk in every single position you put on. And so recognizing that and understanding it and acting accordingly is going to be increasingly important, I think, as we go through this year.
Yeah. So you recently tweeted, if you don't follow Grant on Twitter, you're missing out, because he just has some zingers in his tweets besides lots of wisdom, but the zingers crack me up. You have such a great dry sense of humor. And anyway, he recently tweeted out about ARKK as the apotheosis of the everything bubble, the tech extravaganza, and the pillaging of retail by shameless charlatans. What lessons do you think traders and investors need to learn from that as well? It's further evidence of what you've already said, but I can't. I had to quote that because that was just such a mouthful.
It's a great question, and I think I constantly think about a story I read or a transcript I read of an interview with Stan Druckenmiller, which was done by Ken Langone a number of years ago, probably 10, 15 years ago. And Stan famously had sat out the tech bubble when he was working for Soros and the Quantum Fund. And he'd ultimately piled into dot-com stocks right before the bubble burst and lost $1 billion of Soros's capital. Whoa. And he was being asked about this by Ken Langone on stage. And he said, look, talk us through what happened. And Stan said, look, I had these guys sitting on the same desk as me, young guys who were making so much money and having so much fun. And eventually I just couldn't help myself. I dived in and I lost $1 billion. And Ken said to him, well, what did you learn from that? And Stan's answer was just fantastic. He said, I didn't learn anything. I knew I shouldn't have done it, but I did it anyway. And I think that is such an important lesson to learn, because for anyone that sat and watched, you've picked the example of ARK, and we could pick any number of examples, but let's use the ARK as an example. If you've seen this stuff before and you've stayed out of it and you haven't been sucked in, there really isn't a lesson to learn about that. What the lesson you can take away from it is to remind yourself just how fervent people can get about an idea that is fashionable or is in vogue or is attracting capital or is an idea that sells a dream in an environment where dreams are heavily bid for, which is what we've had in this zero cost of capital age. So I don't think the lessons I learned about it were not about art, because I looked at it, I didn't want to go anywhere near it, but I was fascinated to watch people's reactions to it. Yeah. If you got burned by ARK, then hopefully you've learned not to buy into the hype. Now, that's not to say there isn't promising technology to invest in, there isn't promising ideas, but rather throwing money blindly at insane valuations, despite people saying to you, look, this stuff, it doesn't make any money, it can't survive unless there's 0% interest rates. These are the lessons that you have to take away. You can't lose this kind of money in something like that and say, I was unlucky. Next time it'll work out. You have to understand what it was that saw these valuations fall like they did. And the other lesson I would say, look, disruption is good, right? But this idea of disruption has become a buzzword. It's become a way for people to sell investment ideas. And we clearly haven't seen the end of ARK yet, because despite an 80% fall in the NAV of the ETF, inflows are still strong. So people are still believing buy the dip, buy the dip, buy the dip. I suspect of a few of these stocks that Kathy Wood has in the ARC Technology Fund, ARC Innovation Fund, go bust, then we might suddenly see people start to pull their money out, and that will be another interesting period. But there's that great saying. What's the great saying? The early bird gets the worm, but the second mouse gets the cheese.
Right.
So this idea of disruption is a good one, but you have to understand. The dot-com bubble in the 2000s, we saw this. We saw billions of dollars thrown at fiber optic cabling, for example, and all these companies went bust. But the companies that came in afterwards and bought the assets for pennies on the dollar were able to parlay those into great companies and offer us internet for $19.95 a month, because they didn't have to spend on the infrastructure that had already been done and the capital written off. So that, there's always lessons to learn. And I think putting anything down to luck, either dumb luck or good luck, is a real waste of an opportunity to figure out why you got lucky if you made money. Or don't forget to do those kind of postmortems if you make money as well. Why did I make money? Was it because of the thesis I had going in? Did that play out, or did something else happen? Because oftentimes that's the case, and you have to be honest with yourself and say, look, I thought I was going to make money because of this. I got that wrong. I still made money, but file that away for next time.
Yeah. So mindset seems to be a theme and a lot of what you're speaking to. How would you advise investors increase theirs, right? As a coach, I'm a complete advocate of mindset and self-awareness, because all of that informs those choices you make. But how do you personally, and what is the suggestion to the investors that you have in your robust audience? How do you caution them to make sure they are paying attention and watch their mindset, hone it?
Yeah, I think excuse me. I think flexibility is incredibly important. Having the ability to change the way you think about something is incredibly important. Whether it's intellectual flexibility or, the older I get, physical flexibility. Those me sitting down in this chair all day. But the other thing is humility, and I think if there's one thing you're going to take away from this conversation, this idea of humility, this idea of parking your ego whenever you sit down at your screen, will save you more money than just about anything else. Because as I talked about my friend James Aitken recently, I've just spent some time with him in London talking to him, and he's built an extraordinary career. And as we talked about his career and talked about how he done what he'd done and why he'd done what he's done, this idea kept coming across in what he said. Is this the idea of trying to be less wrong? And I think it's such an important way to look at things, that we're all trying to be less wrong rather than be more right. Because within that, there's a certain degree of humility that accepts the fact that we're going to make mistakes. Every day you're going to make mistakes in trading. And the trick is to recognize them and not be wedded to them, and not let pride make you hold on to a losing position longer than you should, simply because you don't want to admit, I screwed up. And if people can just understand that screwing up is all part of this, if you get 6 out of 10 right and 4 out of 10 wrong, you're going to have a phenomenal career. You're going to do just fine, as long as you have the same discipline and the same process around all 10 of those. You're going to do just fine. So there's really nothing wrong with being wrong. And the other thing James said, which stuck with me in the moment, and I've been thinking about it so much since then. He said to me, people always ask me about my 31 years of experience. And James says, I always say to them that I don't have 31 years of experience. I've had 1 year of experience 31 times. And again, it's so simple. It's such a simple distinction. But it's brilliant. If you think about it for 2 seconds, you just realize how true that is. And that isn't to say that one of those 31 years, or in my case, Christ, almost 40 years, won't be applicable to 2023.
Right.
But this idea that 31 years of experience means something is completely wrong, because you could you could sit back and there may be years where you've forgotten about, or things that happen in years that your mind's blotted out, or whatever it may be. But if you think that each year is a new experience, and some of them are going to be similar and some of them are going to be the same, but
It's beginner's
highly likely that
mind.
no 2 years. Yeah, exactly right.
Beginner's
Exactly right.
mind.
So so I think things like that are just so important to realize,
Yeah.
and to hear, to hear people put them into words that you can just kind of let sink in
Yeah.
over a beer or a cup of coffee or something, and really think about them. It changes the way you look at an awful lot of things, and I think that comes back to this idea of being flexible and being willing to change the way you look at things when you
Yeah.
hear stuff that challenges it.
It sounds like an attachment, the truly being able to be unattached, but that takes work, takes some effort. Charlotte, I don't know if we have time, but I thought maybe you could give us, or give Grant, 1 or 2 questions, if there's 1 or 2 that you're seeing repeated in the collection of questions. We don't see the questions ourselves, so.
Yes, we do have quite a few questions. We don't have any time, but I can try and squeeze one in there for you.
Sure.
Let's see. This was the first question anyone asked, so I'm going to go ahead and ask Charles's question. Can you provide us with any views on precious metals in 2023 and later years, if possible? I'm interested in USD terms. Thank you.
Yeah, look, I'm actually, funny enough, I'm actually in the middle of writing a piece about this very subject right now. So yes, I think the setup for precious metals is incredibly positive going into 2023. To be clear, I've been an advocate of precious metals for some time now, not from a price perspective. I tend not to talk about, I think the price is going up, I think the price is going down. I talk about them from the perspective that owning precious metals as part of your portfolio, whether it's as a liquidity reserve or as a store of value, makes an awful lot of sense. And the percentage that you might allocate to those kind of strategies increases or decreases depending on the kind of broader risk. So as I looked at it, as I was talking through 2022, a lot of people have said, well, why the hell has gold performed so badly in 2022? It was up 1.5%. We had roaring inflation. We had a war in Ukraine. We had energy crisis. All kinds of reasons why gold should have performed well. And I think what people mean by that is it should have gone up in dollar terms, which is a perfectly fair assessment to make. But if you kind of just tweak your perspective and look at it from a different point of view, if you'd invested in gold because you thought the price was going to go up in 2022, you've had a horrible year. You're just scratching your head thinking, I couldn't have been more right, but the price hasn't moved. If you held your gold as a liquidity reserve or a store of value, you've actually had a phenomenal year, because you can go into 2023, and I have the numbers here because I've just been writing about it. You can buy 56% more units of the NASDAQ with an ounce of gold than you could buy at the beginning of last year. You can buy 26% more units of the S&P than you could at the beginning of last year. You can buy 16% more units of high yield bonds. You can buy 26% more units of treasury securities, if that's what you want to buy. Tesla was another one I picked out. You could buy 228% more units of Tesla with the same ounce of gold. So I think if you have it as a liquidity reserve, this is the sort of time you consider deploying that gold and exchanging it for other assets. So I understand your question, but I'm not going to make a price target on gold. I think gold will continue to be a really good asset to hold in 2023. I feel confident the price will move higher, but that's not what I'm looking for it to do. I'm looking to allocate the capital I have in precious metals into other assets as and when I think the value proposition makes sense. I don't think that answers your question at all, but maybe it's a different way to think about it. I don't know.
I'm sure they're very happy with that answer. All right. Thank you so much, Grant and Kim. It's such a pleasure to have you guys join us. That was a fantastic discussion. All of you in our audience, that does conclude our time for this session, but be sure to stay tuned as we have a lot more in store for you today. I hope everyone has a wonderful rest of your day.